Welcome to this explainer. Look, today we're tackling something huge, the absolute core principles of building true wealth. We're going to dive into some incredible insights from financial experts, historical data, and even SEC research to basically build you a reliable blueprint for your financial future. Let's get right into it.
So I want to start with a question that might sound a little crazy at first. Why do high earners go broke? Seriously, think about it. It's so easy to assume that a massive salary just automatically equals a massive net worth, right? But time and time again, researchers and financial planners find that this is a total illusion. Without a strategic plan, even the highest income out there can literally lead to financial disaster. All right, here's our roadmap for today. We're going to cover 1. The high earner trap. 2. The math of wealth. 3. Savings versus investments. 4. Building diversified portfolios. 5. Earning through royalties. And finally, number 6. Protecting your accumulation.
Let's kick things off with Section 1, the high earner trap, or living rich versus building wealth.
You know, there is a stark, almost night and day contrast between living rich and actually building wealth. Financial planners at Skybound Wealth point out this really common trap. The more people earn, the more they tend to spend. That is, living rich. But think about it. If your income just vanished tomorrow, how long could you really maintain that lifestyle? Relying entirely on active income, like your paycheck, is incredibly risky. Building actual wealth means setting things up so your assets grow faster than your spending. It's about having your money work for you, even when you're off the clock.
So what do real, successful wealth builders actually look like? Well, there's this famous 20-year study called The Millionaire Next Door, and it found something amazing. Over 80% of America's millionaires are first generation, meaning they didn't inherit their money, they built it from scratch. And they share these 7 distinct traits. They live conservative lifestyles, spending less than they earn. They're super efficient at allocating their resources. They prioritize actual financial independence over looking rich or having high social status. They are self-made. They teach their families to be self-sufficient. They focus on emerging market opportunities. And a lot of the time, they choose to be self-employed.
To really put the power of those 7 habits into perspective, get this. At the time of that study, there was $22 trillion of personal wealth in the United States. That's trillion with a T. And almost half of that massive mountain of money was held by just 3.5% of households. And guess what? The people in that tiny percentage weren't just making high incomes. They were religiously practicing those specific wealth-building habits we just talked about.
Moving right along to Section 2, the math of wealth, and specifically the leverage of time.
Okay, we have to look at the data from FinToolSuite because it shows us exactly why starting early is so absolutely crucial. Look at the compound interest formula. Notice where the total number of periods, represented by the letter N, sits. It's right up there in the exponent. That is the true source of your leverage. Adding years to your investment time frame compounds your money far, far more aggressively than just adding a few extra bucks to your monthly contribution. Adding money just scales your result in a straight line. But time sends it going parabolic.
In fact, there's this golden rule from the developers at FinToolSuite that hits the nail on the head. They say, time is the only input that grows the power. Everything else just multiplies it. Starting early isn't just a piece of good advice. Mathematically speaking, it is your absolute, ultimate advantage when it comes to building wealth.
All right, Section 3, savings versus investments, the trade-off.
When you look at how the SEC compares savings and investments, it boils down to this. There are really only 2 ways to make money in this world. You either work for it, or your money works for you. Savings products, things like checking accounts and certificates of deposit, they are incredibly safe. But there's a huge trade-off here. They pay a really low wage, and over long periods of time, they almost always lose their purchasing power to inflation. Investments, on the other hand, like stocks, mutual funds, real estate, sure, they carry the risk of losing your principal, but they offer the long-term growth you actually need to outpace inflation.
And digging a bit deeper into those investments, we really need to understand the difference between stocks and bonds. It's pretty straightforward. When you buy a bond, a company or the government is basically just promising to return your money plus some interest. You're a lender. But when you buy a stock, you actually become a partial owner of that company. Yes, you take on more risk if the company struggles, but you also get to reap the rewards if the stock's value shoots up and they start paying out dividends from their profits.
Which brings us to Section 4. Building diversified portfolios to mitigate risk.
Evergreen Financial Group points out something really important. Just owning 5 or 10 different stocks is not true diversification. True diversification actually requires 2 things.
First, proper diversification, which means you're investing across totally different asset types, stocks, bonds, cash, real estate. But it also requires effective diversification, meaning your strategy has to actually hold up under market stress. Like, if you hold stocks and bonds that both crash at the exact same time because they're highly correlated, well, you weren't effectively diversified, were you?
I absolutely love this analogy from Evergreen. They say, investing is a crockpot, trading is a microwave. It's so tempting to jump on the day trading bandwagon looking for those quick microwave-style returns. But historically, long-term investing is what actually wins the game. A recent study showed that almost 95% of people made money in any 10-year period between 1970 and 2020 just by simply holding on to their investments. Just let the crockpot do its thing.
Now, because picking individual winning stocks is notoriously difficult, a lot of people turn to mutual funds or ETFs. These are essentially pools of money managed by professionals. But here's the catch. Actively managed funds come with internal fees called expense ratios, and these can quietly, ruthlessly eat away at your returns over time. This is exactly why so many experts point people towards unmanaged index funds. These funds just passively track a major index, like the S&P 500, using computer algorithms. And because their internal fees are so much lower, historically, index funds actually often yield higher returns than your average actively managed fund.
All right, let's shift gears a bit for Section 5, earning through royalties to expand your income.
According to Zero's Financial Guide, a royalty is basically an ongoing payment made to an asset owner for the right to use their property. Think of it like paying rent, but instead of a physical apartment, it's for intellectual property. This could be a patented invention, a piece of software, a brand name for a franchise, or even creative stuff like music or a book. It is a wildly powerful way to generate scalable, recurring revenue that's completely separate from the stock market. If you decide to dive into a royalty model, there are a few practical steps you've got to take. First, you establish the agreement. And get this fun fact. Granting someone exclusive rights to your asset typically commands rates that are 25 to 50% higher than non-exclusive deals. Pretty crazy. Second, you have to define the payment terms. Are you getting a percentage of the revenue or a fixed fee per unit? And finally, you absolutely must track the sales accurately. Because if they miss payment deadlines in these contracts, it can trigger massive penalties. We're talking sometimes as shockingly high as 18% interest per year.
Okay, we've made it to our final section, number 6, protecting your accumulation, defense, and fees.
Both the SEC and top financial advisors constantly warn about these silent wealth killers. Things like high turnover in a mutual fund. That creates taxable capital gains that you have to pay for, which totally drags down your real returns. Or unmonitored internal expense ratios. Those will slowly bleed your account dry over a few decades. Then there's granting discretionary authority to a broker. That means they can trade your money without even asking you, which sometimes leads to fee churning. And finally, trading on margin, which is borrowing money to buy stocks. That is a massive, massive risk that can wipe out a beginner's entire portfolio in the blink of an eye.
The SEC strongly urges everyone to take control and ask the hard questions before ever handing your money over. Have other investors complained about this specific investment? Have the managers ever been in trouble? Is the person selling you this actually licensed? You literally need to comparison shop for financial advice exactly like you would if you were buying a car or a house. And please, do not be afraid to ask exactly how your advisor is getting paid.
So as we wrap up this explainer, I want to leave you with a provocative thought that really echoes through every single source we looked at today. Are you working for your money, or is your money working for you? Because true wealth, it isn't about the size of your paycheck today. It's about the systems, the math, and the investments you put in place for tomorrow. So take a hard look at your own financial blueprint and start making those adjustments. Thanks so much for joining me on this deep dive, and keep learning.